Okay, let's jump right into this explainer by asking one absolutely crucial question. Why is the global economy basically sleepwalking into a physical catastrophe? Right now, we are witnessing this massive, almost unbelievable disconnect between the pure optimism of global financial markets and the gritty, unyielding facts of geopolitical reality. And it's a perfect starting point, really. This zombie-like stupor in the financial markets. It's almost as if investors are peacefully floating along on fluffy clouds, right past a rainbow, hanging out in what the Economist accurately calls la la land. I mean, stock markets are hovering near record highs, seemingly completely oblivious to the reality of a world at war and these unprecedented global supply shocks that are building up. So there is a glaring disconnect at play here. These zombie markets, and by that I mean speculators in the oil futures market, they're actually betting that oil prices will drop to $88 by the end of 2026. Think about that. That implies some magical, sudden peace and the immediate reopening of the Strait of Hormuz. But contrast that with the actual physical reality we're in. The strait is effectively closed, and massive, completely unavoidable supply bottlenecks are forming as we speak. Part 1. The Strait of Hormuz shut. Let's move to our first hard reality, the physical oil market in the Middle East. We are now 2 months into the war involving Iran, and traffic in this incredibly vital strait, a choke point that normally handles almost a fifth of the entire world's oil, has been near zero. The stark reality is that all the ships that passed through before the conflict had completely docked by April 20th. Nothing is moving. Diplomatic efforts are totally intermittent, and the ships, they're at a complete standstill. So the crux of the crisis comes down to a staggering number, an insurmountable net deficit of 13 million barrels a day. The market has lost roughly 18.3 million barrels a day of crude and refined products that usually exit the strait. Now, even after you account for a tiny trickle still getting through, plus the extra oil bypassing the strait via pipelines in the UAE and Saudi Arabia, we are still missing 13 million barrels every single day. That is a massive gaping hole in the global economy. Part 2. The Great Oil Drain. Well, if the oil isn't flowing through the strait, we really need to look at how the world is handling this shortfall right now. The brutal math of our current situation is pretty alarming. To keep the lights on and engines running, the International Energy Agency agreed to a 400 million barrel emergency drawdown from strategic reserves. But, that's a finite band-aid. The remaining deficit is forcing this entirely unsustainable drain of 6 to 8 million barrels a day from commercial stocks. To put that into perspective, even during the massive post-COVID recovery surge, we never drained commercial stocks by more than 2.5 million barrels a day for more than a single month. Because of that extreme drain, we are literally on a ticking clock. Traders are estimating severe global shortages within just 4 to 8 weeks. We're moving incredibly fast from the current inventory drain to imminent fuel shortages in places like Indonesia and Pakistan within 4 to 5 weeks, which leads directly to broader global diesel and petrol shortages. And all of this is crashing right into the U.S. summer driving season. That's a time of peak demand, which threatens to push pump prices past $5 a gallon. This isn't just a macroeconomic theory. This is the price of your daily commute about to skyrocket. To ground this narrative in undeniable facts, there are already reports from commodities traders of desperately needed barrels of diesel selling for an absolutely wild $600 each. No way, right? But yes, that is double what they were going for just a week prior to those reports. The pain is already here for the people who physically need the product to keep supply chains moving. That brings us to a crucial pivot. The financial market might be trying its best to ignore the oil fires for now, relying on hope and backup reserves. But what happens when its absolute biggest darling, the artificial intelligence industry, also slams headfirst into physical reality? Part 3. AI's silicon supply crunch. Let's pull back the curtain on the digital economy for a second. We tend to think of AI as just software, right? Just magic happening somewhere up in the cloud. But it is deeply, inextricably tethered to the physical world. And right now, the world is absolutely gorging on it. Weekly token consumption, which is the metric used to measure AI output, literally quadrupled in just 3 months between January and March of 2026. The demand is so intensely high that it's forcing tech giants like Anthropic, Amazon, and OpenAI to actively ration their compute power. They're literally having to tell paying customers no, because they just do not have the capacity. And why don't they have the capacity? Because of gritty, physical bottlenecks completely halting AI expansion. Building new data centers requires physical permits and massive power grid hookups. Then you've got severe shortages of basic electrical gear like transformers and gas turbines. On top of that, essential hardware like high bandwidth memory chips, GPUs, and even CPUs are totally sold out through 2026. You simply cannot code your way out of a hardware shortage. There is a terrifying financial mismatch unfolding in the tech sector right now, too. The five major cloud hyperscalers, Amazon, Google, Meta, Microsoft, and Oracle, are shelling out more than $750 billion on data center capital expenditures this year alone. Yet the hardware suppliers who build the actual chips and servers, they're investing less than a third of that amount. Hardware makers are cautious, they're wary of overbuilding, and that caution is creating a massive, unyielding choke point for the entire AI industry. Which brings us to this incredibly hard-hitting realization from Amrita Sen of Energy Aspects. You cannot substitute flows with stocks. That quote just perfectly links our two crises together. Whether you're draining commercial oil reserves to make up for a closed shipping lane or exhausting the global supply of silicon and power grid capacity, you cannot simply run on empty reserves forever. The flow actually has to resume, or the whole system breaks. Part 4. The Physical Reality Collision. We are rapidly approaching the exact moment where these zombified financial markets violently collide with the unyielding limits of physical reality. Look, animal spirits, good cheer, and speculative bets, they can sustain a stock market bubble for a surprisingly long time. They can keep investors happily adrift in la la land. But the actual economy? It doesn't run on good vibes. It is physically tethered to the petrol pumps that dictate the costs of your groceries, the shipping docks that move your goods, and the physical silicon inside massive energy-hungry data centers powering your entire digital life. When supply falls short of demand in the physical world, prices absolutely must rise, and shortages become an unavoidable mathematical certainty. So, I'm going to leave you with this final thought. With fuel tanks running dry across the globe and the digital world hitting a hard, unyielding silicon wall, exactly how long can the world afford to keep sleepwalking? The physical limits are here, and the reckoning is literally just weeks away. Thank you so much for joining me on this explainer. Keep your eyes on the physical data, not just the market sentiment, and really think about how these profound bottlenecks are going to impact our reality in the coming months.